Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for November 25th, 2024. We are recording this at 1 p.m. Eastern Time, and this is episode number 456. So for today's show, I've arranged for the option professor to be back for a market outlook episode. I'm going to turn it over to him in just a second. But in case you did not see this earlier, see this last week, we had a huge 2025 Outlook event. We had 33 different or 34 different presentations. All of our favorite educators providing their best educational advice or information and outlook and that sort of thing for the year ahead. So if you did not catch that, that's all available on TimingResearch.com. And you can access that at any time and catch up. So now I'm going to go ahead and turn it over to the option professor of optionprofessor.com.
Okay, thank you, David, and thank you everyone for being here. We've done a lot of webinars here in the last 24 hours. We had a very large one with trading indicators yesterday, and we had hundreds of people sign up, so that was quite a nice meeting. I would like to just introduce myself. I'm Jim, the option professor. I've been in this option business here for decades, and I've done seminars for people throughout the country and in Canada as well over the last, many, many decades. So basically, my training in the background, I was at the Options Institute in Chicago for advanced option trading a long time ago, and I've traded thousands and thousands of options on my own. So basically, what that all means is I'm qualified to explain these to you, and I think I obviously have a certain amount of knowledge about options that many people don't. With regards to today, I'm going to give you my opinions and my observations, but of course, nothing I'll be giving will be advice because obviously that comes from yourself and your broker and other people. I just help you with ideas and information. Okay, so what's going on here? Well, if you got my alerts, again, I'll talk about this at the end, but I have an options alert service where you get a course and you get ideas every Sunday night. Well, this Sunday night, I'll give you a little tip on what I said. I said when the S&P is up 20% or more going into the end of the year, a lot of times the returns are very measly, averaging about 1%. So there are many people looking for this big rally going into the end of the year, and certainly they thought that today. But I had a cooler head today because, again, I'm not looking for a huge year-end rally right now because of the statistical historical numbers that say that I think the best it ever did was around 2% and change, and it actually headed down period between November 21st and the end of the year. When the S&P is up over 20% entering in, common sense would tell you that's because obviously a lot of buying power and people are already in. So if they're already in, obviously you have to find new buyers. If you can't find a lot of new buyers, then obviously you can't go much higher. Basically, that's the logic. Well, that logic led me to think that this rally that we opened up with might not last. So if you go to the 5-day graph here, you'll see that it's pulling back to the mean here. But the one, if you're a short-term day trader, which, if it jumps up like that, you might want to do a short-term trade. You got a nice sell signal here at about 60. Oh, well, the red line starts turning down, that's the time to go. And so basically around 60.05. So it's at 59.70. So what do you got? 35 points to the good. Grab your money and have a nice lunch, right? But that's one of the reasons, like I say, it wasn't surprising to see it back off. It could still go through the roof. Don't kid yourself. Let's look at this thing here on the 1-year graph. I mean, this thing looks like it's trying to break out. And as long as it stays above what? The red line here, which is where? 59.50, which is a long way. Well, it's not a long way. It's 20 points away. It's still the risk is still a melt up to the upside. But I just thought today's action was a little bit, of a spike up. And sometimes spike ups don't last. So the bottom line is I thought there was a nice day trade in there for you short-term traders. And obviously using my hourly graph, 5-minute graph. I call it a 1-day graph on this. It gave me a nice little deal. Actually, all the way down to 59.65. So it's trying to get its footing again. And like I say, this is a very strong market, but it is a market that is getting mature as far as, how high it's going to go. This is 75 on the RSI, and up here we're at 73. So, not a divergence of any size, but certainly, it's a place where it has topped before. And again, reversion to the mean. It happens. When's it going to happen? It's going to happen, but when's it going to happen? Well, there's no evidence of it right now, but when it starts happening, realize the potential of a pullback. What would make it happen? Who cares? But we'll see it when it happens. But if you want to have you know gossip talk here, it might be because of all these initiatives and all these disruptors that are going to hit the market on January 20th when Trump takes over. Maybe not everything works so smoothly, right? And of course, uncertainty and disruption, might not be well received. So, obviously that's it. We're looking for 15% growth in earnings next year. That's a pretty healthy number, 15 to 18% growth in earnings. And you would have to imagine some of that's being discounted by this run up we've seen since the Trump election. So again, could we go to 61, 6,200? Of course, anything could happen because again, it's pointed that way. But the point being is the higher it gets and the further away it gets from the moving average does not make it less overbought nor less extended. And the risk, does not seem to be reducing the higher the price goes. So again, while we enjoy the ride, we stay with it. We have to be cognizant of any signs of a turn. And again, we don't really have that. 59.50 would be my first number of concern right now. It used to be 58.50, and you'll see why that was a great number to look at, because you'll see on here we came down towards the 58.50 level here, right? And again, it held like they've all held. And then basically this line is not bent at all. So it's a very, very steady uptrend, no doubt about it. And buy the dip is the way to go. Buy the dip, buy the dip, buy the dip has been the way to go, right? And if the dip has been huge, like it was in August, then that's a fantastic buy. These are called minor buys, but it's still trugging along, trugging along. Now, where's your RSI up here? It's 68, 68. And where are we now? We're 62. So again, that's a bit of a divergence. That's a bit of a divergence, which means if we start taking out 59.50, probably got a good shot of going back to the blue line. And if they really shake up the world for whatever reason, going down to purple. Okay. So right now, like I say, today's trade was obviously to try to sell the opening or sell the big high there, and then try to make a little what they call a swing trade or a scalp. And the scalp seems to have been done. And now basically we're going to see if this thing can start taking off again. So that's the story on the stock market. The story is pretty obvious. They're looking for lower taxes. Will obviously put more money in people's pocket. Putting more money in people's pocket means more consumer spending, and that's where the earnings growth can come from, right? Because 70% of the GDP is what? Consumer spending. So obviously, if you cut taxes, they got more money, they can spend more money, or they can run up their credit cards more because they can still afford the minimum payment. Whatever they're doing out there, they're obviously doing it in a big way. Again, looking at the relative strength here on this, where's the high here? 73. Next up high up here, 64. Then you got the reversion. Now you got another high up here at 62. So again, it is really a binary thing happening. If we start taking out the highs, maybe it'll be a melt up. Okay. But again, if we started to roll over further, it might be more of an indication that it could pull back. Nobody thinks that. But you see today, pulled right back to the red line. That's why if you're a scalper, you grab the money here, right? Because again, you've got support right there at the low. What was the low? 59.63. Where's my red line? 59.65. So obviously trade against that line is not a bad idea. Plus it filled the gap. So the stock market, like I say, is in a nice big uptrend, and people are looking for 6,600 next year. They're looking for the earnings to jump 18, 15%. And if everything like that works, then we've got one of those markets that's just not going to have a pullback. The average bull run full bull run in the stock market can be 143%. We're only up about 70% from the lows of 2022, 2023. So that's the story as far as that's concerned. Let's take a look at the VIX, because that's been a big indicator for me, the VIX. And let me show you here what we go there. VIX. Okay, there you go. And here we go. Now, this is really going to tell me when Rome is going to ever start burning. And believe me, it's having a trouble getting under this 14 number. You see, it went down here. Did it go to 1350? Yeah, went down to 1350 this month. That's ridiculously low. Then it popped back up to the gold line. So that would have been the time to think that the market pullback was over, because that's where the VIX was topping. So that would have been a good indicator to start looking at the buy side. And now the VIX has come all the way back down here. And there is a bit of a gap there that hadn't filled yet. I don't know if it's going to fill. But again, it's holding that 1450 number now. And now it's at 15. If I look at longer term, which I think is important, this VIX is really on a rock bottom down here. Because if it can really substantially stay underneath the red line, which comes in at 1506, see, it's back above 1506. If it can stay under that, then I think the 6200 makes some sense. Okay. If this thing cannot stay under that, and for whatever reason the news changes at all with the type of people, the amount of positioning that is long right now, I think it would be very, very possible that we would get a correction that people aren't used to. Again, a lot of the, not a lot, some of the prognosticators I have heard are looking for a January or February significant pullback. So I don't know if this is buy the rumor, sell the fact, right? Whereas they buy the rumor, Trump's coming. And then when he gets in there, maybe they sell the fact. I don't know. But I do know this. I'll be watching the VIX very closely, because if it starts jumping above 1850, you're going to see a very significant correction. That's my view. That's why I'm sharing it with you today. And then when that starts happening, there'll be plenty of room on the downside, because you can see what kind of reversion to the mean you got. I mean, let's just go back there so you get an idea. We don't fight the tape. I mean, the tape is strong right now, no doubt about it. Okay, we're not fighting the tape, but we're not thinking that what happens today lasts forever. Again, there's a lot of reversion potential on the 20-year. There's a lot of reversion right down to 5,800 on the 5-year. Okay, 5,800 from 59.77. That's 200 S&P points. That's quite a bit. And then a more significant one can take you all the way down toward the blue line. And the blue line here on a more severe pullback is all the way down at 55.14. So the net is underneath the market. The market's on the high wire. The market's doing fine. The Bandini brothers are flipping around. Nobody's falling off, right? But if they do start falling off, the net is, in my view, fairly substantially lower than where we are now. On the short-term net, the short-term net's at 59.50, which I just told you, and then 58.80 and 58.58. Remember last week, the lows around 58.50, right? So that's why that held down there. And that was a place to do your buying against the support, where obviously the risk between where you get in and where you might get out might be very narrow. Now you have to, if you're using 58.50, now you're risking 120 S&P points as opposed to, just a little bit when it was down there at the lower price. All right. Another big news is going on is the difference between IGV and the semis, because it looks like people are jumping they're jumping into the software. Look at that. Why are they jumping into software? Because again, semis is a commodity. They come up with a new chip. They don't want to. They bought enough chips, and then you got a problem. Where the software has got more legs to it. I heard it's got a better profit margin. So at any rate, that's where the money's gone, and you can see if you compare it to SMH, I think it's pretty favorable as far as the difference in the acceleration. Yeah, so there you go. Is that your evidence you need? You want to see evidence? You just saw it. People are putting money into software and they're not putting money into the semis. And again, I think these guys with the chips are probably coming out with all kinds of chips and all different price levels. And so it's it was a one horse race, and maybe still is a one horse race on Nvidia. But what do you call it? The other companies aren't sitting on their hands, AMD and the rest of them, and they're trying to come up. When some companies are coming up with their own chips. So again, there's a reason why this thing is faded out, because again, people are starting to think, hey, listen, we'll get some other chips at other places cheaper. We'll come up with our own chips, which are way cheaper. We got enough chips. These are the problems that NVIDIA is facing right now. So again, when Tom, Dick, and Harry and the whole world is in there, if you look at a long-term graph on the darn thing, take a look at it. I mean, this thing is the poster child for a reversion to the mean, possibly, right? And it does revert to the mean. You remember when it was up here, it came all the way down to 90. Of course, that was the time to take your shot. Up here, you might have some problem here. RSI is up at 85 up here. That's a pretty high RSI, isn't it? And then here you got what? An RSI of 78. And over here you got an RSI of 59. That's a divergence. That's a divergence. So that can be a problem. Now, RSI divergence can be corrected by a big move to the upside. So that's not enough evidence. You'd want to see some of these red lines pointing down if you actually wanted to be negative on it. And they're not really crossed or going down. So this could just be a pullback, particularly if you can get back above blue here. And blue comes in at what? 120, well, 140. So if you get back above 140, you might want to look at the long side again, because the blue line is pointing up very nicely. So this could be a buying opportunity. I'm not saying it's not. But I am saying, obviously, on a longer term basis, I don't like that divergence in the longer term charts, which shows you that this rally is a little bit weaker on relative strength than the last one. I don't like the idea that other companies are coming up with different chips at different prices, and some of the big companies are producing their own chips, because these guys obviously are very sharp people, and whatever NVIDIA is doing, I'm sure people are trying to come up with something similar. So that gives you a little bit of a eye opener to why the semis are kind of lagging, and that of course makes the QQQ lag. But QQQ pretty much the same as S&P. It had a gap there, it just filled it, and then of course it has to hold 495, which I've been telling people 495 is a big number. So pretty much between here and 495 is your support. Breaks under 495, then of course it opens the door. So we'll have to see exactly how the tech works. Last one is your small caps. Everybody loves the small caps, even though 40% of the index has companies that are losing money. That's kind of a good stat, huh? But the other ones are people are interested in. And again, they're interested in it because, again, this thing has a lower PE. It's supposed to have some immunity towards the tariff problems. Some of our companies are tied into these other countries, hook, line, and sinker. So if you do tariffs on them, there could be problems with the supplies, or, changes in their relationships with the local governments, whatever. The Russell doesn't have that problem. Of course, Russell is really just getting back to the former highs right now. You see, there's your high right there from 2021 at 244. And where are we today is 244. So we're pretty much in the same zone. Is there a divergence? Let's see. First time we were up there last time, RSI was 62. And up here we are at 65. So no divergence, no divergence. But certainly the time to buy is when it's next to support. Not after it runs up. This is supposed to be where you're having a good time with it. So there's your opportunity right down there. If you want to take a shot, it filled in the gap, it hit the support, bam, that's where you take your shot. Up here, I don't know, not with my money. So basically that's the story on the three big indexes. and the VIX, which I think are the big stories looking forward. So that's why I'm trying to show it to you. All right, I'll show you a couple other big stories today. The yellow metal. What happened to the yellow metal? The yellow metal is having a bad day. And why is it having a bad day? Let me see why. It is having a bad day because the prices are going down. How about that? It's having a very bad day. It's $85 down. What would make it do that? Well, here's what. They just announced the Treasury Secretary, right? And the Treasury Secretary, I was watching him on Bloomberg, and he said, it is, quote unquote, it is absurd to think that Trump will be inflationary. Well, absurd is a pretty big word. And if the Treasury Secretary uses it in terms of inflation, and I owned a bunch of gold, I wouldn't consider that to be bullish. So obviously, I'm not the only one who wouldn't think it's bullish. And so there you go. Did you get any indication of this thing turning over? Well, look at your 5-day graph. You had a high point here. What was the RSI? 66, 81. Woo, 81. And then you had the pullback. Runs up to this big new high, 64. Wow, that's a divergence. Once the red line points down, it's time to leave town. And that was at 27.15. So $100 ago, you were told on the 5-minute graph between the divergence in the RSI and the red line pointing down that you should get out of town. If you didn't heed the warning, now you're down here. 1 month graph, how's that look? 1 month graph turned down as well, 2,700. And now this is the place where you'd probably take a buy. Why? Because it's right on purple. So if it's going to stop, guess where it's going to stop? Right around here. What's my number on purple? 26.25. Where are we trading? 26.25. So monitor it here because this would be the place for it to stop. If not, I don't see anything underneath it. Let's go to the 1 year. You see how it stopped right there at 25.50? So obviously that is a very big support zone. If you're longer term on gold and it takes out 25.50, sorry to tell you, it looks like maybe it might be rolling over. Let's look at the 5 year. Reversion to the mean, guys. Reversion to the mean. So where could it go if it starts breaking under 25.50? Well, at 25.50, it does have some support right there at 25.29 and then 24.50. So there's your next key numbers for gold. If it's going to still stay in an uptrend, if it's still going to be a good market. And there's no evidence that it's not on the longer term basis. On a short term basis, they broke it. And they broke it right down to a pretty good support zone at 25.25. 26.25. The next big important number down I can see is 25.50. So if we break here, 25.50 would be the next one that I'd be looking at. But that tells you there's plenty of room if this thing had a full-blown correction. I mean, people would be surprised, but going down under 2,400, under 2,200, and 2,000 is not off the table. That is called a reversion to the mean. Can you see this up here? We're at 1,800. If I tell you it's going to revert to the mean over time, now it did take time to come down, but it did revert to the mean, didn't it? And if you were owning it during this period, you were not making any money. So that's what you have to be cautious of is when something stops going up, your ability to make more money is going out the window if it can't go higher. So what's your magic number on gold right now? It's 2,800. In fact, I told a buddy who is heavy into the gold, I said, listen, the story's pretty simple. 2,800 is your ceiling. We're trading 2,700 and change. If it breaks 25.50, you're probably going to go into a full-blown correction. And so basically, you know, that's the broad strokes of gold. But like I say, right now, at this second, is definitely banging on support. And if I go to the 5-day graph, RSI on this thing is at 23. The first leg down here went to 21. So you got 21 down here, and the new low is 23, 25. That's a bit of a divergence. And look, you see it's very low. They're both about the same, even though it made a lower low. On a one-day graph, is there anything that could tell you that it might be turning up? Well, what were the lows down here? Well, over here, where were you? You're at 27 down here. Then you got a low over here, 31. And then you got a low over here of 32. Not a big divergence. So like I say, this thing may not hold the 26.25, but it wouldn't shock me if it did. And if you did start seeing it trade above 26.35, that would be a good sign that 26.25 is a floor. So again, sometimes it's better to buy at a higher price than a lower price from the standpoint of the momentum and the direction. So 26.35 might be a good one. And then basically, like I say, since it fell into the abyss so far, it may go into a choppy phase, a sideways phase, on a best case scenario using 26, where we are ballpark here. Again, if it goes through here, I don't see anything down here. Do I see anything on the 1 year? Well, what's that red line trying to hold on to? That's probably around the same price we're at. Yeah, 26.29. Well, there it goes a little bit, 26.22. So it may be on a destiny to get and test that 25.50 again. It's possible. But again, if you're following the stuff I am, there's no reason to be long it right now. All right, let's talk about crude oil. And by the way, this is the reason I like to do the strangles as far as my ideas are concerned, because people walked in today and did they think gold was going to drop $100 almost? No. And you think the gold stocks are probably going up or down? Well, let's take a look. You got Newmont Mining. And Newmont Mining is down, right? Okay, so is that Newmont Mining going to take out the low and break down here into the 30s? I don't know. It could. That's the way things are pointing. Or it could hold here. The gold could hold the 26.20 neighborhood and rally back up. So that's why the strangle makes some good sense, because up here, like I say, if you had a call and a put and it goes way down, that's good for you, right? If you just had calls up here, you'd be in trouble. Turning towards GDX, which a lot of people trade. Again, like I say, if you're bullish up here, but you don't put any puts on there, and all of a sudden it tanks, you're going to be happy you had some puts. Right now, say you had calls, it was going up nicely. Now it's breaking to the downside. And is it going to go down and test the gold line? It could. And again, on a longer term basis, there is room underneath. You see, there is room underneath on a long term basis. So a pullback is not. Again, the trends on a long term basis are still up. This Treasury Secretary says absurd that Trump is going to be inflationary, but absurd things sometimes happen. So again, they haven't given up on the long-term trend on gold, but that 2,800 is starting to look like the Eiffel Tower right now, until they stop bringing it down, and then of course resume some kind of an uptrend. All right, let's go to that oil. Not bad, a little bit down, but again, doesn't look that great here, right? On a 20-year graph, it's really right in a big zone. That's why on the gold and the metals and the energy, I've looked towards the March contracts for options, and here's why. I just showed you the VIX is dirt cheap at 15, 14, right? When the VIX is dirt cheap, that means option prices are generally very low. When options prices are very low, you can buy time for not that much more money. And obviously, your expiration date and your strike prices are key to your success and your premiums to trading options. So if I can lock in the time and not put up that much more money, which was the case with the oil stocks and the gold stocks and the copper stocks and the aluminum stocks, then I think that's the time to do it. And then what do you got? You got the end of the year, you got the beginning of the year, you got Trump coming on board, you got Trump's policies going into place. I think that could cause a lot of volatility in energy and metals. So obviously, I'm thinking out in March is a better place to sit. And so that's why I did it. Most of the options I work with are like 1 month deals, right? Because I'm looking for either earnings to make a move or something's happening in the sector or whatever. But when you get options dirt cheap, in my view, they're getting pretty darn dirt cheap. And you can do both sides, and you can go out until after Trump gets in, and he's going to be in there for almost 2 months by the time these things expire. Well, within 2 months, I think you'll have a pretty good idea. If there's a bunch of military trucks going down Main Street picking up illegal illegal immigrants, I think that's going to be shocking to some people. If he goes around and starts tariffing like a madman, that's going to be shocking to people. So again, these guys are called disruptors, right? They're coming to Washington to disrupt the deep state, the swamp, whatever they call it, right? Well, disrupting can work 2 different ways. It can work out well or it can work out not well sometimes, right? So again, if they can cause volatility and we're doing the strangle, that would be a friend to us. If we can buy a lot of time for not that much money because the VIX is down, that should be a reasonable idea. So there you go with the crude. And look, hang on for dear life. I mean, Donald Driller Trump is coming, right? Drill, drill, drill. Well, that could bring a lot of supply into the market. If it brings a lot of supply into the market where it's already kind of oversupplied a little bit now, well, you could be looking at $50 crude, $40 crude, wherever it wants to go to. I mean, that gold line hasn't really broken, since a long time. If I go out 20 years, this gold line goes back to 2022. The purple line, I'm sorry, purple and gold. So that's why I've been saying the $62 range to 65, that is your lows. And if you get underneath the 60, let me give you the exact numbers here. If you get under the 62 number, you're going to be looking at, obviously a lot of things. Now, here's what I would say. Look at your RSI here. It's never really breaking under 40. That is key. That is telling me that this market is still holding on, which means if it's not going to break under 40 on the RSI, you're not going to get an acceleration to the downside. And if you don't get an acceleration to the downside and something happens geopolitically or whatever, then this thing obviously is at the lower price. Look at your RSI here. It's still in the 40s. That's very important. Very, 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 very important. I'm not going to get bearish on this oil until it breaks 62 and the RSI breaks 40. End of story. Otherwise, I'm thinking that it's a lull before a storm. And just imagine if it did take off with the kind of base that it has built between 60 and 75. I mean, that's a pretty good base, that $15 window, right? So if it ever breaks out either up or down, the move could be pretty significant. Let's look at the 1 year. And the 1 year, you had a 30. See, again, you're not much under 40 here. You're above 40 there. You're above 40 there. And you're above 40 there. So what am I saying? I'm saying that don't get negative on energy until we break $62 in crude and until the VIX can break under 40. I mean, the RSI can break under 40. Then it'll be game, set, match, and then you can stick a fork in crude. But if not, these options are dirt cheap going out way into next year. On what companies? I'll show you what companies. This is the biggest holding in energy for Warren Buffett. I mean, he was selling Bank of America. He's selling Apple. He's not selling this thing. And can you see why now? Because again, it's near a low point here. And let's take a look at, RSI 23, RSI 50, RSI down here 45. You get the idea? It looks like a market that is a little bit running out of steam of sellers. Now, again, you break 62 and you get RSI under 40 on crude. I'm sure this stuff will fold like a lawn chair. Again, you're down here, and you're trying to, you're trying to keep the RSI right around 40. So on the 5-year, it's trying to hang in there. Plenty of resistance. Like I tell people, if it gets above 82, it'll fly. So there could be an opportunity here in energy shares, possibly, if we don't break 62. What kind of an opportunity? Well, you go back on a long-term graph here. Let's look at long-term graphs. If this thing can get back above 60 and the blue line is still pointing up, right? So, and there's a traffic jam there. If this thing ever gets above 60, for sure, I'd be extremely excited, because then it would open the door for all these numbers up here. So keep an eye on this, because 2025 could be the year of this stuff going, because everybody's thinking oil's dropping. He's going to be drilling. Inflation's coming down. Half price gas. That's all lovely. That's what the plan is, right? Okay. Like Mike Tyson says, everybody's got a plan until you get hit in the face. So, these guys, if they get hit in the face on this stuff, it might change the deal. I don't like the blue line rising if I'm going to be bearish longer term, because the blue line generally is declining when prices drop. And that's not what's happening here. This could be what I would call a mouse job, where they try to get it underneath the averages for a while, get everybody negative, everybody's selling. Who's buying? The market makers, Citadel and the rest of them. And they're providing liquidity down here. And then the next thing you know, something happens, you jump above 60 and you're on your way. I'd monitor that like a hawk, because that could be one of the better opportunities of 2025. A couple of other my favorites in this region, which cost a little less, a little cheaper, is Devon. You'll notice the chart is pretty darn similar. Right on. Hey, listen, right on the line. Right on the line. It's going to be feast or famine on this thing. That's why I thought going out to March made sense, because why? I think within 2 months after he's in there, the oil stocks and the oil prices may make a decision. And if they go to $50 a barrel, this thing will be way down here. And if they don't, and they start going the other way, this thing's got a lot of room on the upside. Same thing with Schlumberger, drill, baby, drill. That should be up their alley, because you know what they do? Drill bits. So if you want to go drill, baby, drill, how about buy the drill bit company? This is another company. I mean, they're ditto. There's 3 horses to play right there if you want to do energy. But if you wanted to be patient until it got higher and then go from there, you could do that as well. All I would tell you is that I don't think energy will be flat through the whole year. If it is, I'd be surprised, and it could. But I am expecting some disruption, right? I'm expecting some disruption to the norm, and the norm has been pretty flat lately. And let's look at Bitcoin. Now, I've been very good with Bitcoin, because I'm just following what they tell me on the charts here. Well, Bitcoin didn't like 100 grand, apparently. Okay, here's the deal. When we're down here, that's when I'm slamming the table, talking about MicroStrategy at $145, talking about MicroStrategy at $180, talking about Coinbase at $150, talking about Mara, talking about Riot, talking about Hut, all of them, right? In fact, I've got a special report on Bitcoin that goes out with people who subscribe to my service. And it's very helpful. There's 14 stocks I've identified as key players. Now, here's what I think on this thing. And I'm no expert at this thing, I'm telling you right now. But what I've read and what I think are reasonable arguments are as follows. After they do halving, now halving happens about every 4 years, 2012, 2016, 2020, 2024. After they do halving, historically, the Bitcoin's gone up about 300% within 12 to 18 months, is what I've read, what I've been told. If that's true, we started at 50,000 when they did the Bitcoin split, and that 12 to 18 month frame goes off the board in June of next year. So, do I think it could go to 150 grand, which would be 3 times 50 grand? Yeah, I think it could. Why? I don't know, because history tells me it could. And I can see people are more than happy to buy this stuff. And with the deregulation and possibly it going into people's portfolio as a standard percentage of asset allocation, and with all the different ETFs that are going to be coming out, and maybe corporations and pension plans and insurance companies and banks can start buying it. I don't know what Trump's going to let everybody, and he's talking about a strategic Bitcoin fund. Well, I mean, this thing could have a hell of a lot of money going into it. It's got a market cap now of about 1.7 trillion. Some people think it can go up to like 10 trillion if all these people start playing ball. So that would obviously make it possibly go to the 150. The other thing is your purchasing power. I mean, I get it now. It cost $1 million to buy a house that used to cost 500 grand. It cost 75 grand to buy a car that used to cost 50 grand. It costs $17, $18 to get a vodka martini where it used to be 11. I get it. So that's why this Bitcoin is so interesting, because it does have a finite quantity, and it is obviously following the stock market as well. If the stock market were to have a big drop in January or February, I would imagine this stuff will come down as well. There's a gap there right there on Bitcoin. Well, this is at 80,000, 77,000. Would it shock me to go down and fill that? No. And look where the red line is, 75. So where would I be more interested in coming on board? 75, right? 75. Will you get there? I don't know. Today it looks like it wants to go down there. Again, this Treasury guy is respected. Why is he respected? Because he worked for George Soros, because he worked for Jim Chanos, because he is a heavy hitter in the hedge fund business. Used to work with Stanley Druckenmiller. Okay, these guys are the elites of investing. They're right up there, right? So obviously he's a sharp guy. And if he comes out and says Trump isn't going to be inflationary, and it's absurd, pretty big word, absurd to say that, then obviously stuff that have been going up because of this inflationary fear is going to start backing off. And that's what happened to gold today. And that's what's happening to Bitcoin as well. Again, these are still bull markets, but they're overbought and they're pulling back. End of story. So again, at the end of the broadcast, I will explain how you can get the options alerts and how you can get the Bitcoin report, which I think is pretty good stuff. All right. So let's turn toward a few of the strangles that I've been doing, just to give you an idea on my methodology. Okay. Obviously, not all my strangles will go up as much as these ones I'm going to show you, but many of them have. Many of them have. Okay. So I think the key is diversification and bankroll management, meaning if you have X amount of risk capital, you only put in a little bit of it any one period. Why is that? Because we're going to be doing these strangles as far as the eye can see. And we don't know exactly what month is going to be most volatile. The month of August was tremendous for volatility. The month of September was tremendous for volatility. This month here has been pretty good. Last month, not as much. So the bottom line is that there's always going to be some volatility. Some months are going to be much better than others. And so I like the idea of sector diversification, meaning you do a little tech, you do a little metals, you do a little energy, you do a little healthcare, you do a little airlines, whatever. And basically you try to limit how much you put in so that you can play every month. And again, hopefully at least one or two out of the batch you pick up will have a big move to balance out the ones that aren't. Because again, on the limited risk strangles, you can only lose the premium, but your reward can be as far as it wants to go. All right, so let me show you a couple of my methodology here so you can get an idea. This is SoFi. Now, around the middle of, beginning of October, so let me show you that. Let's go to the 1 year graph, easier to read. Okay, so can you see right in here in October? We get into October, September it turns up, right? And then October it starts turning again, right? right? And it starts really looking pretty good as we get into right around the end of the middle of the month. Okay. That's when I was thinking the earnings are coming out. And I thought it would be a good idea to do an $8 call and a $7 put. And the combination of those went for about 170 bucks. Obviously they were bouncing around. Maybe it was 200 bucks, 170 bucks, 200 bucks, something like that, right? Okay. So you had the right to buy at $8. You see where it's trading down here, right? And you had the right to sell at $7. That's a very tight window. So if it had gone down, you'd have the right to sell it at 7. And if it goes up, you got the right to buy it at 8. Well, they came out with earnings, and for whatever reason, this thing just kept going and going and going and going, and went all the way up to 15. So an $8 call, when it's at 15, 15 minus 8 is 7. So the intrinsic value, the real value, is the in the money amount, which is 700 bucks. So that's an example where a very small amount in before their earnings would have paid off very nicely. And obviously, if you can get a gain like this, if other ones aren't moving very much, you can obviously use the revenue that comes out of a large winner to obviously mitigate a little bit of the losses on some other things you might have if they don't move. But you get the idea why I'm using this stuff and why I thought it would be a good idea. And when I see 170 bucks, I think that's a joke. Again, remember with options, it's implied volatility. When a market has been trading between 7 and 8 for 2 months, there's no implication it's going to 15. Do you understand? That's how you make the money in the options, is you get in when the implied volatility is relatively sanguine. This is one of the ways, not the only way. The relative strength is sanguine, and then you get in, and then the news hits or whatever hits, and you get a big volatile move. And all these people that were short calls and short the stock, they've got to scramble. And if the market has this kind of momentum, who do you think is selling? Market makers. And when market makers are their liquidity provider, they put a very high price on it till the volume dries up. And so they keep raising the offer until they dry that volume up, knowing fully well when the volume dries up, it'll fall back towards these averages on a reversion to the mean. Make sense? Okay, let's go over to another one, which was Lyft. Okay, Lyft was coming out with earnings. Now look at this chart and tell me you have to take a shot at this thing. Here. Where is Lyft? Here it comes. Show your face. All right. So here's the deal. Again, I have to go through many, many stocks to come up with these ideas. I hope you understand that. This is a very long process, hours and hours and hours. And I found Lyft and I said, okay, Lyft has the blue line rising. It's crossing over purple. That's very good. Red is pointing up and so is green. That's very good. It's being halted by the gold line, but the gold line's not going to hold this back. Look at the RSI above 50, strong, right? And so the bottom line is when the options are priced in here, the implied volatility is low, which means the option premiums are low. And if you get news like an earnings report and everybody wants in and the market makers are providing liquidity, they'll put the price at 19 like they did. And then when the volume is filled, it'll come down under its own weight. So this combination was an in the money. Why did I do in the money? You see, the price was around 14. I did a $12 call in this idea, $12 call, and a put underneath at 11. Another $1 window for 231 bucks. Say it was 250, say it was 220. You know, the options bounce around. This thing got news and the market popped to 19. The $12 call went to $7 in the money. Actually, a little bit more because you got a premium. And so that, and then of course, when things spike up, since I am a believer that these markets on a order imbalance do not last, I obviously grab the money and run. Now, with regards to, do you get the idea though? I'm looking for things like that, or maybe I'm looking for things that are way up that could pull back. I'm looking for where I think the option premiums are very reasonable and there's a good shot of volatility showing up. When we're wrong, we can lose the premium. When you're right, you can make a lot. So now I'm going to get into how you can get started on this thing. And David will be putting up a link that you can click on. And obviously, I think you should do it. Now, why should you do it? Well, obviously, what comes with this thing? The first thing you get is you get an options course. It's called the Options Master Class. Myself and Daniel Sinig, who is the founder of Trading Indicators, put this together. It's 6 hours and 3 sessions. You guys have been going around town looking for courses, going around looking how to learn about options. Here, you're going to get this for free when you get into this thing. That's $397 standalone price. We give it away for free because we want you to know what you're doing. So that's number one. You get the options masterclass. I don't care if you've been in options before or you're just beginning. This thing is going to help you in my view. Second thing you get is you get the alerts every Sunday night. Ideas that come to you on things like Lyft and SoFi and United Airlines, just to give you another idea that came out in the last month or so. We had a 65-45 UAL deal. Make that 65-55 for $379. And the stock, look, down here. Now, again, I thought it was going to get good earnings. I thought something would happen. The trend was already up. And so we thought it would jump. We didn't know it was going to jump this high. But, you follow it up with a short-term moving average and you can follow the trend all the way up. Anyway, you get the alerts every Friday night, Sunday night. You also get an overview. I watch all these markets. I think you're getting the idea. I follow these things. You're going to get my view on all these markets. So if you have been out running around all week, you can get a one-stop shop with a review of what's going on in the world. So you get the review, you get the class, you get the strangles, and you also get long-term ideas. I'm going to show you a couple of long-term ideas that we've had in there. These are called where we go out 6 months, 12 months, or more. This I brought to people's attention in the long-term idea. Back when it was at 145 strike and also at 180. Can you see why I'd be interested in it down there? Obviously, this is just home run derby. Nobody knew it would happen. It certainly doesn't hurt that it has happened. Another one was the Coinbase down there. And that was in the 150s, 200s, right? And then another one was Palantir at $31. So like I say, diversification can be helpful because anything that doesn't work, it has a limited risk on it. And the ones that can work, obviously, from $31 to where we are now has not been a bad ride. And some of these options still have time on them. Plenty of time because we went out to way into 2025 on some of these. So that also comes with the report. And so there's two ways to go. You can go with a monthly deal. You get $100 off both of them. The monthly deal, you'll get the course and you'll get the what? And you'll get the ideas for 1 month. What I suggest people do, use your common sense. Look how much money you're going to be working with. Look how long you'd like to trade options. Go with the 3-month deal. Why? Because you're going to get 3 months of ideas. You're going to get the course, right? And you're also going to get coaching. What does that mean? That means you can call me up and we will be talking. You get at least 1 hour included with your 290, and it's 297. So for 297, you're getting 3 months of the alerts, which obviously is a good universe to work with if you think you want to use this thing long term. And you get the coaching plus the course plus and plus the Bitcoin report. So you get a lot of stuff. Now, where's the coaching come in? I've been trading these things for decades. I've traded thousands and thousands of them. You probably haven't. So if you had a question on something, would it be nice to call up and go, "Hey, Jim, this is Joe. I got a question." "Hey, Joe, what's your question? What's going on?" Or, "Hi, my name's Susan. I am looking at the course here and I've got a question." "What's your question, Susan? Let's cover it." So it's nice to be able to talk to somebody who knows who the heck you are, who has a lot of experience and knowledge and options, and is going to give you an opinion and an observation, based on knowledge and experience. And then you, obviously, it's not advice, so you're just going to do whatever you do with it, but at least it's a source of asking a question. I know when you deal with these brokerage firms, it's hard to get people on the line. They want to do everything through a chat room, blah, blah, blah. They don't really know you from a load of wood. That sometimes is not the best way to learn for people. And again, I've been teaching this stuff and educating people on this for a very long time. So I always compare it to my basketball coaching over at the community center for 15 years. I used to coach 6 years old up to 14. Do you know how variant the level of expertise at those ages are? The level of development, it obviously is as wide as you can get. But every player had potential and every player had his own speed of which he was working at. And I learned that through the coaching of the kids, and I transfer that over to teaching and coaching of the people that are doing the options. Some of you guys are just starting out. Some of you guys have traded for a while. You think you might have a handle on it. Some of you guys have been trading for a while and you think you really got a handle on it. Frankly, I got a big handle on it and I learn every day. So there's no question we can develop you further as a option trader. And then, of course, you talk to your brokerage firm about your suitability and your risk tolerance and all that kind of stuff. But at least the knowledge you're going to need comes from something like this. Also, every Tuesday with Trading Indicators, we have a seminar. So we're in contact. You're in contact with us ongoing. So again, I suggest you do the 3-month deal. The coaching costs $200 an hour, and you're getting it for free. So that's included. So you got the 297 for the course. You get it for the Bitcoin report. You get it for the alerts every Friday, and you get it for coaching. That's a clean deal. So please, sign up. And the reason I'm encouraging you now is, like I told you in the beginning, the VIX is low. Donald Trump is coming. The likelihood we may see volatility pick up is high. That is my opinion. If that opinion is correct and we can do some strangles at the right time, that should be beneficial to us. This is the time to learn. This is the time to increase your knowledge and to maybe talk to somebody who knows more about options than you, who is in the business of trying to help you get better. So again, David will put that link up. All you've got to do is click on the link and basically get started. And I mean, come on, there's no better time than the present to get moving. And I'll do my best to make sure you get much more than you put into this thing, so you can get as much out of your subscription as possible. If you have any questions today on anything, my email is optionprofessor@gmail.com, and you can just send me an email if you'd like. We are coming to the top of the hour, and David is going to say we're done for the day, and I'm going to say we're done for the day. But I do encourage you to join up, and I look forward to meeting you and talking to you and trying to help you get better with options. Have a great day, everybody. And of course, have a great, happy Thanksgiving from everybody here at Timing Research, as well as Option Professor and all the guests that David always has. I'm sure they'd all like to say the same thing. Happy Thanksgiving, and we'll see you after the holiday.